Howdy, and welcome back to Miller Momentum. Today we're talking about the Brookmont Catastrophic Bond ETF, ticker ILS, specifically in response to a recent Seeking Alpha piece that downgraded the fund from, quote, buy to, quote, hold. Whatever that means. Seriously, broad stock and bond ETFs should not be treated as hot stocks to day trade. They just shouldn't be. They are more or less permanent portfolio building blocks. Anyway, sometimes I think Seeking Alpha should stay in its lane of expertise, which is mainly individual stock trading. And by the end of this video, you may agree with me. I mean, get a load of the editor's note on this article. This article covers one or more microcap stocks. Please be aware of the risks associated with these stocks. What? Oh, heavens to Betsy, microcap? Bonds aren't stocks. Good golly gee, we need to unpack this mess. But first, a disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. This article makes a few interesting points, but it also makes comparisons that are structurally wrong, misidentifies the causes of a perceived performance gap, and draws conclusions that don't hold up when you look at the actual numbers and the actual documents associated with these cat bond funds. So we're going to work through all of it: the numbers, the fund mechanics, what ILS can and can't hold, how it compares to its closest peer, CBYYX, the new European ETF, CATB, and whether ILS's performance gap to its peers is closable. First, let's get the numbers right. Before we can debate the analysis of this article, we need to accurately look at comparable numbers because the article plays fast and loose here. ILS launched April 1st, 2025. Per the fund's own SEC annual report, from inception through December 31st, 2025, it returned 5.87% net of fees, not the 7% the article cites. That's a trailing 12-month figure that bleeds into early 2026 and is a different measurement period entirely. Be precise about what you're measuring. Um, this article, man. Anyway, the benchmark the article uses for comparison is the Swiss Re Global Cat Bond Performance Index, which is the right index to use. And the article says that it returned 11.40% for the full year in 2025. Well, actually, the article says close to 11%. The article rounds it. That missing 40 basis points matters when you're arguing about a performance gap between bond funds. You can't just round things. No, not in the bond world. And that's a full year, not the period of ILS's performance, so it's not a fair comparison. Anyway, I'm going to put the exact April to December 2025 returns on screen now for several cat bond ETFs and mutual funds. And I'm also going to put up the Swiss Re index so that you can see the actual numbers. Now, here's the more important number the article doesn't give you. According to ILS advisors, pure catastrophe bond funds averaged around 10.1% return in 2025. The UCITS cat bond funds in Europe, they averaged right around 10% for the same period. So the honest peer group for ILS, other daily liquid cat bond funds, returned roughly 10%, not 14%. That 14% in the article comes from, well, I'm not actually entirely sure. I looked at a lot of the returns on this and went into testful.io and did back tests, and maybe there was some confusion with the Swiss Re index. Maybe it came from ChatGPT. I don't know. Could be a hallucination. It sure ain't SHRIX. And SHRIX, as we'll explain, is not a fair peer to compare to ILS anyway. The article's central comparison is built on a flawed benchmark here. And SRRIX, which is alluded to, it's not even a fair peer to any of them because it's almost a different sort of a liquid asset class in some regards. And I'm going to talk about it at the very end of the video. Anyway, um, here's why the SHRIX comparison is structurally wrong. The article leads with the fact that SHRIX nearly doubled ILS's return, 14% versus 7%. And again, not sure where those numbers are coming from, and calls the gap evidence that ILS, and I quote, looks like it's run by amateurs. Really? That's not something I would expect to read in a professional analysis article. This framing doesn't survive contact with the facts either. Putting the inaccurate numbers and comparison period misalignment aside for a moment, let's go ahead and talk about cat bond structure because the Seeking Alpha article gets this wrong as well. First, SHRIX is not completely a daily liquid cat bond fund. It's an open ended mutual fund that holds the liquid subset of the ILS market, plus what's called quota shares. So, quota shares are risk sharing agreements with reinsurers that are generally found in interval funds, providing only quarterly liquidity. That illiquid sleeve carries a significant premium specifically because investors can't get their money out quickly, even if they want to. Morningstar confirms SHRIX's minimum initial investment is $25 million for the institutional share class, the article cites. So the comparison the article is making is a no minimum ETF with daily liquidity and no illiquid exposure versus a $25 million minimum fund with partial illiquid exposure that earns an illiquidity premium. Calling the return gap amateur is not a fair characterization here. The extra return from SHRIX is partially compensation for structural illiquidity that ILS investors are deliberately not taking because an ETF can't take that. It has to have daily liquidity. It's a requirement of the ETF wrapper. Anyway, this is actually explained clearly in Morningstar's own analysis of the cat bond fund space. Open end mutual funds focused on cat bonds invest in the liquid subset of the ILS market. And for investors willing to forego daily liquidity, there is a more financially rewarding alternative in funds that also hold quota shares. Quote, given that investors prefer liquid assets, illiquid assets come with significant risk premiums, end quote. That is not a failure by ILS. That's just how markets work. So let's dig into the fund mechanics because the what can ILS hold question is important and the article glosses right over it. The ILS prospectus, the April 2026 version filed with the SEC, requires at least 80% of net assets in catastrophe bonds. And for the purposes of that 80% test, catastrophe bonds explicitly include quota shares, excess of loss notes, collateralized reinsurance investments, and industry loss warranties. So the mandate is deliberately broad, but the prospectus also tells you why the broad mandate doesn't translate into a broad portfolio in practice. It states that catastrophe bonds typically have maturities between 3 and 5 years, while quota shares, collateralized reinsurance, and ILWs typically have maturities that do not exceed 2 years. And critically, they are privately structured instruments. To redeem shares daily, you need to be able to liquidate holdings on demand. Quota shares and private collateralized reinsurance don't work that way. The ETF format operationally constrains ILS to the publicly traded Rule 144A cat bond market, regardless of what the prospectus technically permits. So the fund's own SEC annual report confirms this in practice. Its portfolio turnover rate for the period of April 1st to December 31st, 2025 was exactly 0%. The fund bought its bonds and held them. It was not repositioning opportunistically into higher spread primary deals as they came to market. That 0% turnover figure is actually defensible for a fund in its first year of this kind. There are 3 to 5 year instruments. They pay coupon, so you don't churn them. But it also means the fund sat on the sideline during what was a record breaking primary issuance year. I mean, 2025 saw $24.8 billion dollars in new cat bond issuance, an all time high. The fund that participates most actively in primary market deals at launch pricing captures the best economics. ILS with a $77 million assets under management and no turnover was not that fund. But, it doesn't really need to be at this point. So let's talk about CBYYX, the Victory Pioneer Cat Bond Fund, because this is the fair peer comparison the article should have led with, but instead buries. Here's something worth knowing up front, because it actually sharpens the argument. I went and read CBYYX's prospectus. Its mandate language is word for word the same as ILS on the illiquid instrument question. Quota shares, collateralized reinsurance, and industry loss warranties all count towards CBYYX's 80% cat bond test. And the prospectus explicitly classifies quota shares and structured reinsurance investments as illiquid securities. So CBYYX isn't some cleaner, simpler, purely liquid fund. It has the same broad mandate on paper. The difference is that Victory Capital runs a completely separate vehicle, the Pioneer ILS Interval Fund, specifically for the illiquid stuff, the quota shares, sidecars, private collateralized reinsurance with all the quarterly liquidity requirements. So CBYYX in practice invests almost entirely in publicly traded Rule 144A cat bonds, same universe as the ILS ETF. This does matter for the argument. It means both ILS and CBYYX are fishing in essentially the same pond. Neither has an illiquid premium return baked in. So the performance gap between them, ILS at 5.60%, trailing versus CBYYX at 9.37% for April to December 2025, cannot be explained by any structural mandate difference. It's a like for like comparison, which makes the gap both more honest and more pointed. CBYYX has been around since January 2023, managed by the Victory Capital team, and its trailing 1 year return is approximately 9.07% as of the filming of this video. And by the way, ILS is catching up at 6.15%. If you're into the silliness of horse race talk and all that, but I'm not. I'm just tossing it out there for context. Anyway, CBYYX is probably a better benchmark for ILS. So let's be precise about what's actually driving the gap here. First, scale and primary market access. CBYYX has grown to approximately $1.75 billion in assets, more than 20 times the size of ILS. In the cat bond primary market, larger funds get better allocations. New issue cat bonds are placed through dealers to qualified buyers, and allocation priority generally follows relationship size and check size. At $77 million, This fund, ILS, is competing for primary allocations against a $1.75 billion fund. It's at a structural disadvantage, and that shows up directly in the new issue discount. The spread difference between a bond's launch price and where it trades in the secondary market. Morningstar has flagged this primary market access dynamic as a meaningful advantage for larger established funds. The co founder of Fairmont Capital, one of the original cat bond specialists, went as far as saying publicly that cat bond ETFs may be subject to too much in frictional costs to run efficiently. I think he's wrong, but I'll get to that later. And once ILS has way more assets under management, this is going to matter less and less and less. Anyway, scale is central to the critique. Second, let's talk about the cash buffer drag here. ILS maintains roughly 7% of the portfolio in cash and short term treasuries to handle daily ETF creations and redemptions. The overall cat bond market yield stood at around 8.80% at year end 2025. Holding 7% in near zero returning cash rather than cat bonds in a year when cat bonds returned a handsome amount is a direct performance drag. Let's be honest. Roughly 50 to 80 basis points of foregone return at the portfolio level. CBYYX doesn't face the same structural cash requirement because it's not an ETF wrapper. Third, the defensive posture. So ILS's own annual report acknowledges this directly. Per the SEC filing, throughout 2025, the ILS ETF was, quote, positioned defensively and income focused, emphasizing diversified exposure to global catastrophe risk while prioritizing capital preservation during peak risk periods. That is the manager's description of its own approach. In a year with no major U.S. hurricane landfall, which 2025 turned out to be, a defensive posture means leaving return on the table. Avoiding concentrated single event risk is sound risk management, but it also means avoiding the higher spread bonds that were the biggest contributors to outperformance at funds that took on more risk. And in recent months, that positioning has looked kind of smart. I mean, SHRMX took a risk and it took a little bit of a hit. It recovered, but more on that later when we compare the rolling 3 month returns of these funds. Anyway, the 3-ish point gap of ILS to CBYYX between two funds investing in the same liquid 144A universe breaks down roughly as structural cash drag, primary market access disadvantage, and deliberate defensive posture, not amateurism. So here's some context that the article doesn't give you. Um, the Seeking Alpha piece doesn't mention this at all, so I'm going to add it as independent context here. There's now a second cat bond ETF on the market, the KRC cat bond UCITS ETF, ticker CATB, launched in Europe in December 2025. It listed on Xetra, Borsa Italiana, and the London Stock Exchange in January of 2026. It's Europe's very first cat bond ETF. And here's why this is relevant to the discussion. CATB is managed by King Ridge Capital, the very same firm, the same Rick Pagnini, or Pagnani, I apologize if I mispronounced that name, who runs the ILS portfolio as sub-advisor. So the team the Seeking Alpha article is calling amateurs just launched a second product in a second market that the European investment community received enthusiastically. That context matters when evaluating the amateur claim tossed around here. It also gives us a useful fee benchmark. CATB's expense ratio is 1.28% versus ILS's 1.58%, a 30 basis point gap under the same portfolio manager. If King Ridge can run a cat bond ETF at 1.28% in Europe, That number may be a reasonable target for where ILS's fees should head as it scales into larger and larger assets under management, though there could be regulatory differences that hinder that kind of fee cut in the United States. I don't know. It's not my area of expertise. The 1.58% cap runs through April of 2027, though, at which point it's going to be reevaluated. Investors in ILS should watch that negotiation closely. I know I'll be watching it. On performance, CATB has been live since December 2025, and its own fact sheet currently states there's not sufficient data to display performance history. And I agree, it's too soon, way too soon. It's almost too soon for ILS. Its asset under management is approximately $12 million, so it's even smaller than ILS was at launch. But there's a meaningful performance comparison between the two coming our way in maybe 12 to 18 months. But what we have now is a fee data point and a signal about team confidence in the asset class. Both are worth knowing. So, can ILS close the gap to its peers? Well, this is the most important question for anyone currently holding ILS. And I do hold ILS. I also hold CBYYX. So let's be direct about the two scenarios before us. Scenario one is organic improvement over time. As assets under management grow, primary market access improves. The proportional cash drag will shrink. A 7% cash buffer matters more at $77 million than it will at $500 million. The fund builds a track record that attracts institutional allocation, which drives further asset under management growth. The ILS team has said publicly that their long term goal is to outperform the broader cat bond market on a risk adjusted basis. If spreads stay attractive and the fund grows, this is credible, but it requires patience measured in years, not months. So, scenario two is a market repricing event. Cat bonds are priced on risk premiums, right? When a major hurricane or earthquake hits and causes significant insured losses, spreads blow out on new issuance. Secondary market prices drop, and managers who can deploy cash decisively into the reset capture dramatically better economics going forward. This is actually the scenario where ILS's cash buffer, currently a drag, becomes a strategic asset. A fund sitting on at least 7% cash that can redeploy into primary deals at post event spreads could generate meaningful alpha relative to funds that were fully deployed going in. Daily ETF liquidity also becomes an advantage when interval fund investors are locked out of quarterly redemptions at exactly the wrong moment. And now, the honest counterpoint here: the current market environment does not favor either scenario in the near term, at least. Artemis reported in January 2026 that with spreads softening at pace, double digit returns from cat bond benchmarks are unlikely in 2026, absent a major loss event. And even a completely loss free year may not deliver double digit total returns given lower risk free rates and reduced spreads. Gallagher Securities data published in March 2026 shows cat bond pricing was down over 20% year on year, with the weighted average discount at margin at 5.34%. So that's near historic lows. And Plenum Investments May 2026 data confirms market yields are running about 14% behind the prior year level. So all of those numbers boil down to it's probably going to be a less exciting year for cat bonds, but that's fine. You don't have to have excitement every year. You probably shouldn't. It's great to just breathe and have something steadily compound for a while. Anyway, the overall cat bond market yield as of late May 2026 was 9.42%, and that's down from 11 to 12% for much of 2025. That's still an attractive absolute yield. These are bonds, and they're yielding, you know, stock level total returns at a fraction of the volatility. But it means the entire peer group may deliver lower returns in 2026. So don't get used to those 11 to 12% returns. It's probably going to be more to like, you know, 7 to 9%, maybe even 5% some years. And that's fine. That's totally fine. ILS will close some of the relative gap to CBYYX and the index this year, probably simply because there's less room for CBYYX to run away. The gap closing story, though, ultimately requires either scale growth or a hard market reset. And that could happen. Anyway, I do want to talk a little bit about what the article gets right, and its bonkers idea about a total return swap. So, first, in fairness, the Seeking Alpha piece gets this right, that the ILS fund does not clearly state the floating rate composition of its holdings up front. A look through the holdings spreadsheet confirms the majority are variable rate notes, but investors shouldn't have to dig for that information. The fund should be more transparent here. But now let's get to the total return swaps suggestion. So the article implies that if Brookmont can't beat the index, they should just do a synthetic swap with an investment bank to replicate Swiss Re index returns. This is presented as an obvious fix. It isn't. Again, this isn't the S&P 500. The Seeking Alpha article is out of its depth, and it shows. This whole world works completely differently. The Swiss Re Global Cat Bond Performance Index is a benchmark, yes, but it's not a tradable instrument, and it's hard to see how it could become one. Structuring a synthetic total return swap on it with a bank would introduce real counterparty risk at a minimum, real basis risk between the swap and the underlying bonds, and costs that would likely put the expense ratio right back where it is or even higher, with the added problem of counterparty exposure that investors in cat bonds are specifically buying the asset to avoid. I mean, we're looking to get uncorrelated returns, right? Artemis has reported that the majority of cat bond fund managers actively choose not to replicate the index and instead prefer to generate their own returns through direct investment because this is a much more wild west of a market than, say, you know, stocks on the New York Stock Exchange. It's entirely different. The suggestion is impractical and gets to the point of this active management. It gets it completely backwards. It's just not easily doable in the cat bond market at all, where bonds are priced through complex processes that often involve teams of meteorologists, seismologists, and climate scientists. I mean, it just doesn't work the way that the Seeking Alpha article thinks it should. So here's the complete picture. ILS returned 5.60% from inception through the end of 2025 against a Swiss Re index return of 10.45% and a pure daily liquid cat bond fund average of around 10%. That gap is real, but not really a cause for concern, in my opinion. The causes are identifiable: a 7% structural cash drag, a $77 million assets under management that limits primary market access relative to funds like CBYYX at $1.75 billion, and a deliberate defensive posture in year one, which is completely reasonable for a new ETF, right? Because you don't want to launch your product and then have a major hurricane hit and have everything just drop off a cliff and then lose all of your first customers. It's just not good business to do that, because people get really, really skittish. For a lot of people, catastrophe bonds are really, really new territory. So if they see their holdings drop like 15% over a matter of a few days, they're going to freak out because they don't understand these instruments yet. They're brand new to the market. Anyway, SHRIX's much higher return reflects illiquid exposure that ILS deliberately doesn't take because it can't take. It's an ETF. Anyway, going forward, the cat bond market is softer. Spreads are down over 20% year on year. Returns across all cat bond funds in 2026 again will likely be lower than in 2025. Then again, they might not be. I could be wrong. We'll see. In that environment, though, ILS's ETF gap to peers may actually narrow in percentage terms because the ceiling is lower for everyone. The longer term catch up story requires assets under management growth, improving ILS's primary market access, a gradual reduction in the proportional cash drag, and positioning to capture the next hard market reset aggressively. None of that happens in a straight line or on a 1 year timeline, let's be frank. The Seeking Alpha article, though, isn't helpful here. It just misidentifies the causes of performance differences between these funds, benchmarks against the wrong funds, and proposes a total return swap that wouldn't work in practice for this investment world. So, if you're in ILS, this is not a panic moment. ILS is a fund to monitor, yes, like with all things, with specific things to watch, like assets under management trajectory, fee reductions as scale grows, and how Kingridge deploys the portfolio in the next hard market repricing. If you're evaluating ILS, go in with clear eyes on the expense ratio, the cash drag, and the scale disadvantage versus CBYYX. If you want a daily liquid cat bond fund and your priority is maximum near term return, CBYYX, if you can access it without transaction fees, front loads, all that kind of stuff, it has the better track record currently and the primary market advantages that come with $1.75 billion dollars in assets under management. But if you believe in the team that runs ILS and want to bet the fund on the fund as it scales, then ILS is a good choice too, especially if you expect a hard market reset to come. Frankly, I'm invested in CBYYX and Schwab because it's offered without any load or transaction fee. And I'm invested in the ILS ETF and Fidelity. In the long run, though, it wouldn't surprise me a bit if they came out to be about the same. Indeed, I'm actually expecting it. Before I go, I want to show you why I'm expecting it, and I also want to show you something else. SRRIX, an interval fund. Those of you who watch my channel regularly know that I like to save some really cool stuff for last. And right here, I want to look at the rolling 3 month compound annual growth rate of ILS compared to CBYYX. And you can see, starting back in November, the gap between these two funds began to close in terms of return. And that's because, again, there's a lower ceiling everywhere for these funds in terms of selecting bonds this year. But there's also probably a very real effect here from ILS continuing to acquire assets under management. So people who want this fund's performance to improve, the best way to do that is to buy more of it so that ILS can get its pick of bonds on the primary market. So, something to keep in mind there. Now, for any brave souls who want to run out and try their hand at an interval fund for pure catastrophe bond exposure, including in illiquid markets, um, be prepared because, as you can see, that blue line is SRRIX, and I know a lot of people have been raving about its performance since 2022, but people don't talk about its performance from 2017 to December of 2022. The thing about interval funds that are specialized in catastrophe bond exposure in the illiquid side of things is that they do have an illiquid premium, but you've got to wait for a very long time sometimes for that to show up. because they have more sensitive instruments that can take larger hits from disasters. And once a person is committed to one of these things, because of the illiquidity requirement, there's only an opportunity to withdraw from the fund once a quarter. And some of these interval funds can only liquidate 5% of their assets every quarter. So you may not even be able to pull anything substantial out if you want to suddenly get out or decide that an interval fund is not for you. Well, too bad, you're locked in. So keep that in mind. That's partly why I like to do, you know, CBYYX or ILS, because I may want to rebalance my portfolio, or in retirement, I may need to pull down a little bit more because of an emergency. But there is an argument to be made for somebody in their compounding phase that has like 30 years to go to do an interval fund, and then slowly, starting at like 10 years out from retirement, shift it into a more liquid fund like CBYYX or ILX. I mean, that's a valid approach, I suppose, but you just need to be clear eyed about the risks that you're assuming with these interval funds, and not approach them as, oh, wow, this is a great opportunity to get massive returns compared to my friends. Don't think in terms of that way. Always, my general rule of thumb is I want to see at least the past 10 years of a fund or strategy so that I can have a really good idea of how this thing behaves in different market conditions and how it behaves over time, so that I can go in with clear expectations about what I'm going to experience from my investments. I hope you enjoyed this episode of Miller Momentum. Don't forget to like and subscribe. We've got some great content coming up. And leave a comment, leave questions. I always enjoy engaging with my viewers. Until next time.